In the ever-evolving world of personal finance and investing, where headlines are often dominated by blue-chip stocks, cutting-edge ETFs, and booming cryptocurrencies, the humble money market fund rarely gets the spotlight. Yet for many investors, both novice and experienced, the quiet workhorse sitting in the background is often a fund like SPAXX or the Fidelity Government Money Market Fund. While it might not generate excitement like Tesla stock or deliver 10x returns like an early investment in Bitcoin, SPAXX plays a critical role in a disciplined and well-balanced financial strategy. In this video, we're going to explore what is SPAXX in depth and how it works, its historical context, how it compares to other options, and why it might be a vital component to your portfolio, even if you never consciously choose it. So what is SPAXX? SPAXX is the ticker symbol for the Fidelity Government Money Market Fund, which is a type of mutual fund managed by Fidelity Investments. It's classified as a money market fund that's specifically a government money market fund, which means it invests primarily in short-term U.S. government securities and repurchase agreements collateralized by government securities. The fund is designed to preserve capital and provide liquidity with a modest level of income. Unlike other investments that can fluctuate significantly in value, SPAXX maintains a stable net asset value or NAV of $1 per share, which makes it a reliable parking lot for cash. Here's what SPAXX typically invests in: U.S. Treasury bills and notes, repurchase agreements backed by government securities, and other short-term U.S. government obligations. These assets are considered some of the most safest in the world, making SPAXX a low-risk, high-liquid investment, ideal for holding cash temporarily or with use in cash management strategies. So what is the role of SPAXX in a Fidelity brokerage account? For most Fidelity account holders, SPAXX plays an invisible but crucial role. It often serves as the core position or a default sweep vehicle for uninvested cash. Here's how it works. When you sell a stock or receive a dividend, the proceeds don't just sit idle. They automatically sweep into SPAXX. When you buy a security, money is automatically withdrawn from SPAXX to pay for the transaction. This automation ensures that your money is always working even if you don't actively trade or invest it. This default behavior is essential for cash management. Without it, your uninvested money would sit in an account earning nothing. With SPAXX, it earns a yield based on prevailing short-term interest rates. To fully appreciate SPAXX, it helps to understand the history of government money market funds. Money market funds were created in the 1970s as a way to give small investors access to higher interest rates than what banks offered in traditional savings accounts. Initially, they were considered innovative tools to combat inflation and interest rate ceilings. In 2008, during the financial crisis, one of the most famous money market funds, the Reserve Primary Fund, broke the buck by dropping below its $1 NAV due to exposure to Lehman Brothers debt. This event caused panic and led to regulatory reforms to enhance the stability of money market funds. As a government money market fund, SPAXX was designed in accordance with post-crisis regulations, which give it a stronger safety profile compared to prime money market funds. These regulations include strict investment guidelines, mandatory liquidity requirements, and daily transparency of holdings. This is why many brokerage firms, including Fidelity, use government money market funds like SPAXX as their default sweep option. One of the biggest draws of SPAXX is that it allows investors to earn income on idle cash without sacrificing liquidity or stability. The yield of SPAXX is not fixed, and it fluctuates with short-term interest rates set by the Federal Reserve. When interest rates are higher, SPAXX can pay an annualized yield of 4% or more, and when interest rates are low, the yield may fall below 1%. As of mid-2025, for example, the 7-day yield on SPAXX has been hovering around 4.9%, which is a competitive return for cash equivalent funds with minimal risk. That's significantly higher than the national average for savings accounts at traditional banks. This makes SPACs particularly attractive in environments with high interest rates. It allows your cash to benefit from rate hikes and high market volatility. Investors can park money temporarily in SPACs without worrying about losing their value. One of the core reasons SPACs is so widely used is its instant liquidity. You can move in and out of SPACs at any time without penalties, fees, or trade settlements that delay access to funds. Key features of SPACs include same-day availability. You can buy securities immediately using the funds held in SPACs. There's no lockup period, unlike CDs or high-yield savings accounts. SPACs doesn't require you to keep your money tied up for years or months in advance. There's little market risk. The NAV stays at $1 per share, so you don't lose principal due to price fluctuation. These features make it more flexible than bond funds and safer than bank savings accounts in some cases, especially when banks offer sub 1% interest on their accounts. Because SPACs primarily invests in U.S. government securities, a portion of its dividends may be exempt from state and local taxes. However, that income is still subject to federal income tax. There are no capital appreciation or long-term growth taxes involved. SPACs is an income-generating asset and not a growth asset. This makes it a better fit for taxable brokerage accounts, temporary cash holdings, or retirees or conservative investors who are looking for low-risk income. It's less ideal as a long-term growth vehicle for tax-deferred retirement accounts, where higher yielding or appreciating assets might be more tax efficient. So who should use SPACs? SPACs isn't just for Fidelity customers. Anyone who holds short-term cash for emergency purposes or dry powder for investing, or even cash flow management can benefit from what a fund like SPACs offers. Ideal use cases include an emergency fund for quick access to money with some interest income, dividend reinvestment waiting room. You could be holding your dividends or cash inflows until you're ready to invest them. It could be used as a market timing buffer. You can hold your cash while you wait for a better market entry point. It could be an alternative to your bank account, especially when SPACs yields are higher than your bank. And it could be used for capital preservation for retirees or risk-averse investors. While SPACs has incredibly low risk, it's not entirely risk-free. There's some considerations to take into account when you invest in SPACs. The first is its interest rate risk. Yield could fall when the Fed lowers rates. There's also an inflation risk. The returns might not always outpace inflation. It's also not FDIC insured, so unlike a bank account, there's no federal insurance. And there's no growth. It's purely for capital preservation and income, not capital appreciation. Still, in terms of safety, liquidity, and ease of use, SPACs is among the most reliable options available. In a world obsessed with growth, speculation, and beating the market, it's easy to overlook the humble role of cash management in achieving long-term financial success. Yet SPAXX, the Fidelity Government Money Market Fund, offers a blend of safety, liquidity, and yield that makes it more invaluable for investors of all ages. Whether you're a long-term buy and hold investor, a short-term trader, or someone simply saving for a rainy day, SPAXX offers a place to store your cash while earning meaningful returns. And in today's higher interest rate environment, the value it provides has never been clearer. In short, SPACs may not be exciting, but it's essential, a quiet, powerful pillar of strong financial foundation for your portfolio. Many investors underestimate the psychological comfort that comes from having a safe place to keep their cash. SPACs doesn't just serve as a technical tool for liquidity, it gives investors something far more valuable, peace of mind. Having your emergency fund or short-term capital parked in SPACs can reduce anxiety and make you clearer, less emotional when you're making financial decisions. This is particularly important during market downturns or periods of uncertainty when fear-based decisions can be costly. Rather than feeling pressured to put your money to work immediately in risky assets, SPACs gives you permission to wait without sacrificing yield or opportunity. It acts as a psychological cushion, allowing for patience, deliberation, and strategy. One of the biggest criticisms of holding too much cash is something called cash drag, the idea that your portfolio underperforms because a portion of it isn't fully invested in higher growth assets like equities or real estate. But this criticism often overlooks the strategic role of cash. It's there for dry powder for buying opportunities. It helps preserve capital for emergencies or taxes. It preserves capital near retirement, and it causes income generation with low risk, especially when rates are higher. If your uninvested cash is sitting in a checking account earning 0.01%, the drag is a real effect. But if it's just sitting in SPACs earning 4.8%, you're reducing that drag significantly. In fact, SPACs' return often outpaces inflation-adjusted bond yields during certain economic cycles. The key isn't avoiding cash, but managing it intentionally. SPACs allows you to turn idle capital into protective liquidity. In the financial independence space, there's a growing emphasis on building cash buffers to cover 1 to 3 years of expenses, particularly in early retirement. Many FIRE or financial independence retire early followers fear drawing down their stock portfolio in a bear market, known as sequence of returns risk. SPACs is an ideal tool for this if you have 1 to 3 years of expenses going directly into SPACs. Remaining assets are in your index funds, real estate, and growth assets. It allows retirees to weather downturns without panic selling. The result is a safer withdrawal strategy, more predictable income, and greater peace of mind. While SPACs is very versatile, it isn't a one-size-fits-all solution. There's many times when it's not the best option. The first is for long-term growth investing. SPACs is not designed for growth, and it won't beat inflation over decades. Use equities or bonds for this long-term goal. The second situation is ultra-high yield chasing. Riskier assets like covered call ETFs or corporate bond funds might offer higher yields, but come with significant risk. SPACs won't compete with this income, but it offers stability instead. And the third situation is international investors. Non-US investors may have different tax or currency considerations that make SPACs less attractive. So how do you set up SPACs in your Fidelity account as your core position? If you're a Fidelity user and want to use your uninvested cash to go into SPACs, first log into your Fidelity account and then go to the Accounts and Trade section under Account Settings. Click on Core Position, and then choose SPACs if it's not already selected. Note, for some retirement accounts, SPACs might already be set as the default. In others, you might need to change it from FDRXX or an FDIC-insured cash sweep vehicle. Adding SPACs as your core position means that it'll automatically add any uninvested cash into SPACs. SPACs isn't flashy, it doesn't make headlines, but it's a cornerstone of money management and an unsung hero in your financial toolkit. It protects your capital, it gives you flexibility and freedom, it earns you income on your idle funds, and it makes your portfolio more resilient during downturns. In the short term, SPACs helps your money do something while you plan your next move. In the long term, it can serve as a critical bridge between saving and investing, between volatility and safety, and between fear and control. SPACs is more than just a money market fund, it's a strategy in itself. That's why I have SPACs in my portfolio, and I currently use it for my emergency fund. If you enjoyed today's video, please be sure to hit the like button and subscribe to the Financial Freedom Show to stay up to date with the latest videos we post here on the channel. Feel free to comment down below if you have SPACs in your portfolio or you're planning on adding it after watching this video. Love to hear from you guys in the comments. And make sure to check out the membership link in the description. You can have your name featured at the end of every single video we publish, as well as have access to our videos a day before they're published. So check that out below, and hope you guys enjoyed. I will see you next time. Thanks for watching.